These 8 states are quietly pulling as much as $3,000 a year out of retirees' pockets, and most seniors have no clue they are even affected. The list of taxing states actually shrank in 2026. West Virginia finally dropped its tax on Social Security benefits as of January 1st. That still leaves 8 states that skim money from your Social Security before it ever reaches your bank account. And here is the part almost no one explains. Even in the states that recently removed their Social Security tax, some retirees are ending up with a bigger bill this year than last year. Not smaller, bigger. That is because a separate federal rule layers on top of whatever your state does. The combined impact, if you live in the wrong place, can quietly strip between $1,000 and $3,000 a year from a retiree's spending money without ever appearing as a standalone charge. Most retirees never notice this drain because their state does not label it a Social Security tax. It is buried inside the normal income tax calculation as a taxable share of your benefits. You only see it if you work through the numbers, and when you do, it is usually too late in the year to reverse the decision that pushed you over the line. By the time you reach the end of this video, you will know the exact 8 states that still tax Social Security in 2026, how each state decides whether your benefits are taxable, the 2 separate federal income thresholds that apply on top of state rules, the 1 new deduction Congress quietly introduced for 2025 that offsets part of the damage for people over 65, and the 5 strategies that can cut or remove this risk before the current tax year is locked in. I am Mark, with more than 10 years watching the financial system from the inside and seeing retirees blindsided by rules no one ever walked them through. Today's rule is especially nasty because you cannot see it. Most retirees in these 8 states do not realize their state taxes Social Security until the year they suddenly owe the money. That is why the first step is confirming whether your state is on the list. There are actually 2 totally different approaches states use to reach into your benefit check. The first type is the easier one to describe. 4 of the 8 states apply a fixed percentage to the portion of your Social Security that is already taxable at the federal level, no matter how large or small your total income is. Those first 4 are Colorado, Utah, Montana, and Minnesota. If you live in one of these and any part of your Social Security appears as taxable on your federal return, your state automatically takes a cut. Colorado is the most common surprise because the state markets itself as friendly to retirees. Colorado charges a flat 4.4% income tax. Retirees age 65 and older can subtract the entire federally taxable portion of their Social Security. That sounds straightforward, but here is the catch. Retirees between 55 and 64 can only subtract up to $75,000 of retirement income if single or $95,000 if married filing jointly. That means any early retiree who starts Social Security before 65, which is typical for people who file at 62 to fill a gap before other income, pays the full 4.4% on the taxable share of benefits until they hit 65. For a couple collecting $30,000 a year in benefits, with 85% of that amount taxable at the federal level, the Colorado bill before age 65 is more than $1,000 a year, and most do not see it until after the tax return is done. Picture a Colorado couple in their early 60s. One spouse filed for Social Security at 62 and stopped working. The other is still working part-time to keep health coverage going until Medicare starts. Together, their income lands just above the $75,000 retirement deduction cap for a single filer because the working spouse's pay alone crosses that line. As a result, Colorado's full 4.4% rate hits the taxable portion of the early filer's Social Security. Over the 3 years between claiming early and turning 65, the pair hands over more than $3,000 in state tax on benefits that would have been 100% exempt if they had structured the timing differently. That money is gone forever. Nothing is refunded when they turn 65. It is simply the extra cost of receiving Social Security in Colorado before the age-based deduction becomes available. Next is Utah. Utah has a flat 4.5% tax on income. The state offers a Social Security benefits credit, but it shrinks and eventually disappears at higher income levels. full relief only applies if your adjusted gross income stays under $54,000 as a single filer or $90,000 for a married couple filing jointly. So the Utah retiree whose combined income from a pension, part-time work, and required minimum distributions pushes them above that threshold loses the credit entirely. For a couple just past the $90,000 line, the extra state tax tied to Social Security alone can reach about $1,400 a year on benefits the federal government is already taxing at up to 85%. Montana taxes Social Security using the same basic framework as the federal government, which sounds straightforward until you see that Montana's income thresholds have barely budged in decades. The base threshold is only $32,000 for married couples filing jointly or $25,000 for single filers. Those figures were set many years ago and have never been indexed to inflation. That means nearly every Montana retiree who has any additional income at all will see up to half of their benefits dragged into the state tax formula, and Montana's rate on that portion can run as high as 5.65%. For a married couple receiving $28,000 in Social Security, with 50% of that amount included in the state calculation, the Montana bill is close to $800 a year. Not devastating by itself, but it stacks on top of all the other taxes. Minnesota is the fourth fixed-rate state and easily the most complicated. Minnesota provides a subtraction that completely shelters Social Security from married couples whose adjusted gross income is under $18,320 or single filers under $84,490. Stay under those amounts and you pay nothing on benefits. Once you cross those lines, the subtraction starts to phase out and the state tax grows quickly. Around 29% of Minnesota's Social Security recipients still pay state tax on their benefits. That is nearly 1 in 3 retirees. For those in the phase-out range, the typical state tax on benefits runs between $1,200 and $2,200 per year. So if you live in Colorado, Utah, Montana, or Minnesota, and your income is anywhere over the exemption levels I just mentioned, your state is skimming a portion of your Social Security every year. Most retirees in these 4 places never receive a special notice. The tax is hidden inside the standard state income tax calculation. The other 4 states operate in a completely different way. The second group of 4 states is where timing issues can really sting. Connecticut, New Mexico, Rhode Island, and Vermont do not use a flat percentage approach. They rely on adjusted gross income thresholds. If your income sits below a certain figure, none of your benefits are taxed. If your income goes even $1 above that figure, a taxable share suddenly appears and the state begins taking its cut. The dangerous part is that most retirees do not cross those lines because of their usual yearly income. They cross them because of a one-time event, a Roth conversion, a larger than normal required minimum distribution, the sale of an investment property or vacation home. Any single large taxable move in a single year can push a retiree over the limit and trigger a state tax on benefits that had been totally exempt the prior year. Connecticut starts taxing at $75,000 of federal adjusted gross income for single filers or $100,000 for married couples filing jointly. Above that line, the state includes up to 25% of Social Security benefits in taxable income. That sounds like a limit, but it only limits the percentage of benefits, not the dollar amount. So a couple with $120,000 of adjusted gross income and $36,000 in Social Security benefits can see up to $9,000 of those benefits counted as taxable at the state level. The Connecticut tax on that slice can approach $600. Imagine a Connecticut retiree age 70. For 6 years, she has paid 0 state tax on Social Security because her normal income stayed just under $90,000. In 1 year, on a friend's advice rather than a professional's, she converts $60,000 from her traditional IRA into a Roth IRA. That single move tacks $60,000 onto her adjusted gross income for that year and shoves her over the $100,000 mark. Connecticut instantly exposes 25% of her benefits to state tax. The extra state bill alone is close to $500. But the bigger issue is that the same conversion also vaults her federal combined income above the 85% threshold, adding several $1,000s more to her federal tax. If she had split the conversion into 3 smaller annual chunks that stayed under the state limit, the total tax cost would have been minimal. A brief call to a certified public accountant before pulling the trigger could have changed everything. But by the time the return was filed, the calendar year was closed, and the transaction could not be reversed. New Mexico sets higher thresholds, which makes staying under them easier. Single filers with less than $100,000 of income or married couples with less than $150,000 can deduct all their Social Security. But the moment your income goes beyond those amounts, the deduction is wiped out. For most filers, there is no gradual phase-out in New Mexico. It is what accountants call a cliff. Being just $1 over the line can mean hundreds of dollars in extra state tax, because the deduction does not fade out, it simply shuts off. For a New Mexico retiree hovering near the threshold, a single Roth conversion done without checking the year-to-date income can generate a state tax bill on benefits that were fully protected the year before and will likely be fully protected again the year after. Rhode Island is the third state in this cluster, and it uses a different kind of test. The state only spares Social Security from tax if you have reached full retirement age, which is 67 for most people nearing retirement today, and your adjusted gross income stays below $117,000 for most filing categories, or $133,750 for married couples filing jointly. So a retiree who claims Social Security early at 62, intending to draw income before hitting full retirement age, is taxed by Rhode Island on the entire federally taxable portion of those benefits for the 5 years until age 67, regardless of how low their total income may be. The danger here is tied to age rather than income, and many early claimers have no idea that this rule exists. Vermont is the final member of the second group. Vermont grants a full exemption for joint filers with adjusted gross income of $70,000 or less, or for single filers and married filing separately with $55,000 or less. Between those thresholds and a higher phase-out ceiling, a partial exemption applies. Once income exceeds the upper limit, Vermont taxes the entire federally taxable portion of Social Security at the normal state rates, which run between 3.35% and 8.75%, depending on income. For a Vermont retiree who takes extra consulting income for part of the year or receives a one-time large distribution, the state tax on Social Security can vault from $0 to almost $1,500 in a single year. So this second group, Connecticut, New Mexico, Rhode Island, and Vermont, creates timing traps that the first group does not. You can sit below the line for a decade and then trigger the tax in one unlucky year because of a decision you never realized was tied to Social Security. Now here is what surprises almost everyone. Even if you live in one of the 42 states that do not tax Social Security, the federal government still taxes up to 85% of your benefit. This rule appears in Internal Revenue Code Section 86 and has been in place since 1983. The problem is that the income thresholds that trigger federal tax on Social Security have never been indexed for inflation, not even once in more than 40 years. The federal thresholds are $25,000 of combined income for single filers or $32,000 for married couples filing jointly. Combined income is defined as adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. Above the first level, up to 50% of your benefits become taxable at the federal level. Above the second level, $34,000 for singles or $44,000 for joint filers. Up to 85% of your benefits are taxable. These amounts were set 4 decades ago. $1 then is roughly equal to $3 now. As a result, almost every retiree with any meaningful additional income is in the 85% federal tax zone today. The real cost shows up when you combine a state Social Security tax with the federal Social Security tax. Take a couple in Vermont receiving $36,000 a year in benefits and having total combined income of $80,000. They can see $30,600 of their benefits taxed at the federal level, plus an additional state tax on the Vermont calculated portion. The federal tax alone on that $3,600 at a 22% tax bracket is more than $6,700. Vermont's tax on top adds another $1,000 to $2,500. So the total tax hit on Social Security alone can climb above $8,000 a year, and most of that comes from the federal side, not the state. Many retirees never mentally separate the federal and state pieces and therefore never think about ways to reduce the combined burden. Consider a Minnesota couple in their mid-70s. Their house is paid off. They receive a modest pension of $24,000 a year, and each spouse collects Social Security. Together, their benefits total $34,000 annually. Required minimum distributions from their traditional IRA add another $45,000. Their adjusted gross income shows up at around $103,000. They feel financially stable and do not view themselves as high earners. But under the federal Social Security formula, their combined income lands far above the $44,000 upper threshold, which means 85% of their benefits are taxable federally. On top of that, their $103,000 adjusted gross income sits just under Minnesota's subtraction cutoff of $118,320, so the state subtraction still protects them for now. One bigger required minimum distribution next year, triggered by strong market performance that lifts the IRA balance used to calculate the minimum, could push them over the Minnesota line. The state tax on their Social Security would jump from $0 to roughly $1,900 in a single year, and neither they nor their tax preparer would necessarily connect that spike to Social Security. They would simply see a larger state tax bill with no clear explanation. Congress did, however, quietly introduce one offset in 2025 that most retirees have not heard about. It is known as the Senior Deduction and was enacted as part of the One Big Beautiful Bill Act. This provision grants an additional $6,000 deduction for taxpayers age 65 and older, on top of the usual standard deduction for tax years 2025 through 2028. For a married couple, where both spouses are at least 65, the combined extra deduction is $12,000. The senior deduction is reduced at higher income levels. The full amount is available to single filers with modified adjusted gross income of $75,000 or less, or married couples with $150,000 or less. Above those levels, the deduction begins to phase out and disappears completely at higher incomes. So middle-income retirees, the group most likely to fall into the 85% federal Social Security tax range, benefit the most from this new deduction. The Treasury Department estimates that, because of the senior deduction, about 88% of Social Security recipients now pay no federal tax on their benefits. But that statistic hides the reality for the remaining 12%. The 12% who still pay are generally retirees with larger pensions, bigger investment accounts, and larger required minimum distributions. For them, the senior deduction softens only part of the impact. It does not wipe it out. And crucially, the senior deduction is a federal feature only. It does nothing to modify the state Social Security rules in any of the 8 states we discussed. So for a retiree living in one of those 8 states, the complete picture looks like this. The federal government taxes up to 85% of benefits for anyone whose income exceeds thresholds frozen since the early 1980s. The state adds its own tax layer on top, and the new $6,000 senior deduction reduces only some of the federal cost, leaving the state cost untouched. A retiree who does not review these numbers each year is almost certainly paying between $1,000 and $3,000 more than necessary. The encouraging news is that there are 5 clear strategies that can reduce or remove this exposure. All of them are legitimate, written into tax law, and commonly used by retirees who coordinate with a tax professional. The first strategy is the low-income gap year. If you know you will face a year with unusually low income, for example, the year after you stop working but before you start Social Security, that is the ideal time to complete larger Roth conversions, realize capital gains, or draw extra money from retirement accounts. Your income may stay under both federal and state trigger points, the tax cost is small, and those assets move into accounts that will not cause future Social Security taxation. A certified public accountant or enrolled agent can calculate the exact limits for your situation and state well before December. The second strategy is domicile planning. Moving to a state without a Social Security tax is not a quick, casual fix. It requires establishing a true primary residence, not just spending winters there. A tax attorney or state tax expert should handle the filing details if you choose to move. If you are already thinking about relocating to be closer to family or for lifestyle reasons, verifying that your destination is one of the 42 states that do not tax Social Security is basic homework. Arizona, Florida, Nevada, Pennsylvania, South Dakota, Tennessee, Texas, Washington, and Wyoming have no state income tax on retirement income at all. Each state has its own criteria for what counts as legal domicile. The key point is that states examine domicile in similar ways. Your driver's license, voter registration, where your primary physician is located, where your mail shows up, and how many nights you actually spend in the new state all matter. Most states use a 183-day rule, meaning if you spend more than half the year in your old state, that state still treats you as a tax resident. That is why a retiree who moves to Florida in January but spends summers at a Minnesota lake house may find themselves owing tax in both states during the transition year. A tax attorney should explain the exact domicile requirements before you move, not afterward. The third strategy is careful Roth conversion timing. For retirees in Connecticut, New Mexico, Rhode Island, or Vermont, performing a Roth conversion during a year when your income would already sit near the state threshold is a costly move. Doing the conversion in a year when your income is clearly below or clearly above the state line is often cheaper because it either avoids the cliff entirely or triggers it once instead of spreading it over multiple years. A certified financial planner or tax expert should project the multi-year effect before you complete any conversion over $50,000. The fourth strategy is using qualified charitable distributions. A qualified charitable distribution lets a retiree age 70, 1 to 2, or older send up to $18,000 per year in 2026 directly from an IRA to a qualified charity. That payment does not count as taxable income. It can satisfy the required minimum distribution while keeping adjusted gross income lower. This makes qualified charitable distributions one of the most powerful tools for retirees near a state threshold who already give to charity. A tax preparer or enrolled agent should help set this up. If the money passes through your hands first, you lose the tax benefit. The fifth strategy involves timing your required minimum distributions themselves. Federal rules say you must take your first required minimum distribution by April 1st of the year after you turn 73. If you take that initial distribution in the calendar year you turn 73 instead of waiting until the following April, you spread the withdrawals over 2 years instead of stacking 2 distributions into 1 year. For retirees near a state Social Security threshold, that stacking effect can push combined income from below to above the line in a single year, suddenly turning on the state tax on benefits. Dividing the distributions keeps each year's adjusted gross income cleaner. A tax professional should guide the decision using income projections for both years. All 5 strategies are legal, explicitly supported by the tax code, and widely used by retirees who sit down annually with a certified public accountant, enrolled agent, or tax attorney. The common theme is that they must be planned before December 31st. Once the calendar year ends, most of these opportunities vanish. The 8 states that will still tax Social Security in 2026 are Colorado, Utah, Montana, Minnesota, Connecticut, New Mexico, Rhode Island, and Vermont. West Virginia has dropped off that list. The federal government taxes up to 85% of Social Security for any retiree above thresholds that have not changed since 1983. The new Senior Deduction offsets part of the federal impact for most retirees, but does nothing about state tax. And the combined yearly cost of ignoring these rules for a retiree in the wrong state who mistimes a Roth conversion or a property sale ranges from $1,000 to $3,000 every year, potentially for the rest of retirement. Your action plan this week is simple. First, pull out your most recent state income tax return and find the line that lists the taxable amount of Social Security benefits. If that line is higher than 0 and you live in one of the 8 states we covered, you are on the list. Second, call a certified public accountant or enrolled agent before year-end and ask them to project your combined income against both the state and federal thresholds for this tax year. Third, based on that projection, decide whether any of the 5 strategies fit your situation. Put the plan in motion before December 31st.